Welcome to Belhaven University Lectures. What you are about to hear is a podcast based on course material selected by the course developer. It was generated by Google Notebook LM, a generative AI. Please contact your instructor if you have any questions related to the content. Okay, let's get started.
Today, we're doing a deep dive into a really interesting part of tax law, income exclusions. Think of these as, specific types of money or benefits coming in that, even though they feel like income, the tax code lets you leave out when you figure out what you owe. Our goal today is to really clarify the difference between these exclusions and things that, just aren't considered income at all.
Right. And we'll look at a bunch of different scenarios you might run into. Things like bonuses, scholarships, maybe compensation if you're injured, life insurance money, benefits from your job, that sort of thing. We want to try and break down these rules, which can seem pretty complex, into something clear and hopefully useful for you, maybe spark a few aha moments.
Excellent. Okay, let's get started. First things first, maybe we should define what an income exclusion actually is from a tax standpoint.
Good place to start. So fundamentally, an exclusion is an item that, it has the characteristics of income. It's a gain, a benefit to you. But Congress has specifically written laws to take it out of the calculation for taxable income. You'll find most of these rules in sections 101 through 140 of the Internal Revenue Code.
Okay, so the law deliberately pulls it out. Why? Is there a reason behind these exclusions?
Yeah, there are usually a few reasons. Sometimes it's about providing tax relief in certain situations. Other times it's to encourage specific activities they think are good, like, say, getting an education. And some exclusions are just part of how the income tax system is designed, sort of fundamental to it. The key thing is exclusions apply to things that do qualify as income initially.
Okay, let's take that example from the material, a gift. It says a gift is income to the person receiving it, but then it's excluded. That seems a bit counterintuitive.
It does seem that way at first glance, but it highlights the definition perfectly. A gift increases your wealth, right? So it is income in an economic sense. But the law then says, okay, even though it's income, we're excluding it from your gross income for tax purposes. It's crucial to contrast this with things that just aren't income to begin with, what we might call non-income items.
Non-income? Like what?
Think about borrowing money.
Yeah.
You get cash, but you also get a light of, you have to pay it back.
Yeah.
So there's no net increase in your wealth. It was never income. Or getting your own money back, like the principal you invested.
Right.
That's just a return of your capital, not income.
Got it. So exclusion income, but specifically made non-taxable by law. Non-income, never considered income in the first place. That's clearer. Okay, let's dive into some common exclusions. Gifts and inheritances, generally tax-free, right? That's what most people think.
Yes, for the most part, that's correct. Gifts usually aren't taxable income to the recipient. But there are conditions. It needs to be voluntary, given without expecting something of equal value back, what the law calls adequate consideration. And the motivation should be like affection, respect, generosity, that kind of thing. Not just a sneaky way to pay for services.
And inheritances, same deal.
Pretty much the same. Assets you inherit when someone passes away are typically not subject to income tax for you, the beneficiary. Now, estate taxes are a different matter, but for income tax, usually excluded.
But you mentioned a catch earlier. What about income that comes from the gift or inheritance later on?
Ah, yes. That's the key distinction, the initial gift or inheritance itself excluded. But any income that those assets generate after you receive them, that's generally taxable.
For instance.
Okay, say you inherit some bonds. The value of the bonds themselves isn't income tax to you. But when those bonds start paying interest, that interest income you receive is taxable.
Right. Makes sense. What about employers trying to call payments gifts to employees? The material seemed skeptical.
Very skeptical. The IRS almost always sees transfers from an employer to an employee as compensation. Payment for work.
Even if they label it a gift.
Yeah, the label doesn't really matter. The relationship itself implies payment for services. Now, there are specific exclusions that might apply in the workplace, like certain employee achievement awards or maybe reimbursements if there's a disaster, but a simple cash gift, almost certainly taxable income to the employee.
Good distinction to remember. The material also mentions employee death benefits and group term life insurance. How are those handled?
Okay, employee death benefits payments from an employer to a deceased employee's family can be tricky. If the employee had a right to that money before they died, like unpaid salary or a bonus they'd already earned, then it's usually taxable to whoever receives it. It's like the employee received it. But group term life insurance is a common benefit. If your employer pays the premiums for the first $50,000 of coverage, those premium payments are not counted as income to you, the employee. That's a nice tax break.
And this term, income in respect of a decedent, sounds very formal.
It does, doesn't it? Often called IRD. It basically means income the person who died had earned or had a right to receive, but they hadn't actually gotten the cash before they passed away.
Like that bonus example again.
Exactly. If they earned the bonus but died before payday,
Right.
when that bonus is eventually paid to their estate or a beneficiary, it keeps its character as income and is taxed to the recipient. It's income in respect of or related to the decedent.
Okay, that covers gifts and inheritances pretty well. Let's shift to life insurance proceeds. Generally excluded if paid because someone died. Why is that?
Correct. The general rule is that proceeds from a life insurance policy paid out because the insured person died are excluded from the beneficiary's gross income. The thinking behind it is, well, partly that it functions like a tax-free inheritance. It's also seen as helping to replace the economic loss that the beneficiaries suffer due to the person's death, provides financial support.
I saw something about accelerated death benefits. What are those? Are they excluded too?
Yes, those can be excluded too under certain conditions. Accelerated benefits are when someone who is terminally or chronically ill can receive some or all of their life insurance payout before they die. If someone is terminally ill, the exclusion generally covers the full amount. If they're chronically ill, the exclusion might be limited, often tied to the costs of their long-term care.
Okay. Now, there was a warning about transfer for valuable consideration. It sounds like a situation where the exclusion might not apply.
You caught that. It's a really important exception. If a life insurance policy gets sold or transferred to someone else for something of value, money, property, whatever, then the death benefit received by that new owner can become taxable.
How much becomes taxable?
It's generally taxable to the extent the proceeds exceed what the new owner paid for the policy, plus any premiums they paid after acquiring it.
Are there exceptions to that exception?
Yes, quite a few important ones. If the policy is transferred to the insured person themselves or to their business partner or a partnership they're in or a corporation where they're an officer or shareholder, the exclusion generally still applies. Also, if the transfer is structured so the new owner's basis is determined by the old owner's basis, like in a gift situation or a tax-free exchange, that usually preserves the exclusion too. The idea is often about keeping the benefit within a close economic group.
Good to know. Selling a policy to a stranger could have tax consequences then. What about investing the life insurance money after you receive it? Any earnings taxed?
Oh yes, absolutely. The exclusion only covers the death benefit payout itself. If you, as the beneficiary, take those proceeds and invest them, buy stocks, put it in the savings account, any interest, dividends, or capital gains you earn on that money are taxable under the normal rules.
Makes sense. The exclusion is on the payout, not the future growth. All right, let's pivot to scholarships. Something many listeners might deal with. Usually non-taxable, but there are limits.
That's right. Scholarships and fellowship grants are generally excluded from gross income if they're for a student pursuing a degree at an educational institution. But, and this is a big but, the exclusion only covers the amount used for specific things.
Which are?
Tuition and fees required for enrollment, plus books, supplies, and equipment required for the courses.
So if the scholarship also covers room and board, that part's taxable.
Exactly. Any amount given for or used for living expenses like room and board is considered taxable income. The logic is that those are personal expenses, not direct costs of the education itself.
What about grad students who get assistantships? They get paid, maybe a stipend for teaching or research, often with a tuition waiver. How's that treated?
Good question. The stipend or payment for the teaching or research work, that's generally considered taxable compensation. It's payment for services, even if it helps them afford their education.
But the tuition waiver itself?
The tuition waiver or reduction provided by a nonprofit school is usually excludable. For undergrads, it's generally tuition. For graduate teaching or research assistants, those tuition waivers are typically excludable too, recognizing their role at the university.
Okay, moving to a less happy topic, but important. Compensation for injuries and sickness. The tax treatment seems to depend heavily on what kind of injury and what kind of damages.
It really does. The main rule is compensatory damages you receive because of a physical personal injury or physical sickness are excludable from your gross income.
Physical being the key word there.
Absolutely. And this exclusion also covers amounts you receive for lost income if that lost income is a direct result of the physical injury or sickness.
So if I'm in a car accident, break my leg, can't work for 3 months. the settlement covering my medical bills and the wages I lost during those 3 months because of the broken leg is tax-free.
Generally, yes, provided those damages are purely compensatory, meant to make you whole for the physical harm and its direct consequences.
What's not covered then?
Damages for non-physical injuries. Things like emotional distress, defamation, injury to reputation, unless they directly stem from a physical injury. And importantly, all punitive damages are taxable.
Punitive damages, those are the ones meant to punish the wrongdoer.
Exactly. They aren't meant to compensate you for your loss, so they're taxable income. Oh, and there's a specific exclusion for damages someone receives for wrongful incarceration. That's tax-free.
What about workers' compensation if you get injured on the job?
Workers' comp benefits paid under state law for job-related injuries or illnesses are specifically excluded from gross income. Even though they replace wages, there's a clear statutory exclusion.
And if I have my own disability insurance policy that I paid for myself?
If you paid the premiums with your own after-tax money, then any benefits you receive from that policy are generally excludable, even if they replace lost income. That's different from employer-paid disability insurance.
And finally, disaster relief.
Qualified disaster relief payments from the government or sometimes charities after a federally declared disaster are excluded. They're meant to help with essential needs. Also, insurance payments for extra living expenses if your home is unusable due to a casualty. Those are generally excluded too.
Okay, let's talk about employer-sponsored accident and health plans. Super common benefit. The premiums, the employer pays tax break for the employee.
Big time. When your employer pays the premiums for your health insurance coverage for you, your spouse, your dependents, the value of that premium is not included in your taxable income. It's a major tax-favored benefit.
And when you actually get paid back by the plan, say for a doctor's visit, is that payment taxable?
Generally, no, not if it's a reimbursement for actual medical care expenses. Section 105B of the Code excludes payments received for the medical care of the employee, spouse, or dependents under these plans. There's another exclusion, 105C, for payments related to the permanent loss or loss of use of a body part or function or permanent disfigurement, as long as the payment isn't tied to time missed from work.
When would payments from an employer plan be taxable then?
Well, if the payments are really just replacing your salary while you're out sick, often called sick pay, that's generally taxable income, or if the plan reimburses you for something that isn't qualified medical care. And the tax benefit rule could come into play if you deducted medical expenses 1 year and got reimbursed by the plan later.
You mentioned health savings accounts, HSAs. What are the tax benefits there?
HSAs are great from a tax perspective. If your employer contributes to your HSA, that contribution is excluded from your income. The money in the HSA grows tax-free. And then withdrawals are also tax-free as long as you use them for qualified medical expenses. Triple tax advantage, essentially. But you need to have a high deductible health plan to be eligible, and there are contribution limits.
What about long-term care insurance provided by an employer?
Employer-paid premiums for long-term care insurance are generally excludable from the employee's income, although there are annual limits based on age. And the benefits paid out from these policies, whether employer-sponsored or individually purchased, are also generally excludable, helping cover those potentially high long-term care costs. Again, there can be limits.
Okay, let's shift to meals and lodging. When can an employee get those from an employer tax-free?
There are strict rules here. For the value of meals or lodging to be excluded, 3 things must be true. 1, furnished by the employer. 2, on the employer's business premises. And 3, for the convenience of the employer.
Convenience of the employer, meaning?
Meaning there's a substantial business reason for providing it, not just as extra pay, like needing the employee on call. And for lodging, there's a 4th rule. The employee must be required to accept the lodging as a condition of employment.
So like a live-in apartment manager.
That's a classic example. Required to live on site to do the job. Lodging is likely excludable. Meals provided during work hours on site so employees don't have to leave. Might also qualify if it meets the convenience test.
Got it. There are also some specific housing exclusions mentioned for campus housing and ministers.
Right. Employees of schools living in campus housing might get an exclusion, potentially related to paying a certain percentage of the housing's value in rent. Ministers have a significant housing allowance exclusion. They can exclude the rental value of a home provided, or a cash allowance used to rent or buy a home as long as it's designated as such and used for housing. Military personnel also have specific housing exclusions.
Okay, employee fringe benefits. This seems like a huge category. Can you hit some highlights of common excludable ones?
It is broad. Beyond health insurance, you've got things like Dependent care assistance up to $5,000 a year tax-free to help pay for childcare. Use of an on-site gym provided by the employer, usually tax-free. Educational assistance employers can provide up to $5,250 per year tax-free for tuition, fees, books. And right now, through 2025, that can even include payments on student loans. Adoption assistance is another one, up to a limit, though it phases out for higher earners.
What about things like cafeteria plans or flexible spending accounts? How do they work with exclusions?
Cafeteria plans, or Section 125 plans, are key. They let you choose between taxable cash and certain non-taxable benefits like health insurance premiums or contributing to an FSA. If you choose the non-taxable benefit, you get it pre-tax, effectively excluding its value from your income. Flexible spending arrangements, FSAs, let you set aside pre-tax monies specifically for healthcare or dependent care costs. Get reimbursed tax-free when you have eligible expenses. But they usually have contribution caps and that use it or lose it rule, so you have to plan carefully.
The materials listed some other general classes too, like employee discounts.
Right. There are several categories. No additional cost services, like unsold airline seats for airline employees. Qualified employee discounts within limits. Working condition fringes. Things you could deduct as a business expense if you paid yourself, like business use of a company phone. De minimis fringes, small occasional things like office coffee or snacks, generally not cash. Also, qualified transportation fringes, like transit passes or parking, up to monthly limits, though employers can't deduct these anymore. Qualified moving expense reimbursements, currently only for active military. Qualified retirement planning services. And that group term life insurance, up to $50K we mentioned earlier. One key thing for some of these, like discounts and no additional cost services, there are non-discrimination rules, so they can't just benefit the highly paid folks.
Wow, that's a lot of potential tax-free benefits. Okay, changing gears. Foreign earned income for Americans working overseas.
Yes, if you're a U.S. citizen or resident alien working abroad, you have a choice. You can include your foreign earnings in your U.S. income and claim a credit for foreign taxes paid. Or you can choose to exclude a certain amount of your foreign earned income.
How much can be excluded?
For 2025, the limit is projected to be $126,500. But you have to qualify either by being a bona fide resident of the foreign country for a full tax year or by being physically present there for at least 330 days in a 12-month period. Once you make the election to exclude, it generally sticks for future years unless you revoke it. And revoking can limit your ability to re-elect for a few years. There might also be an exclusion or deduction for some foreign housing costs.
Okay. What about interest from state and local government bonds, municipal bonds? Tax-free, right?
Generally, yes. Interest from unis issued by states, cities, counties, etc. is usually exempt from federal income tax. It's a way to help them borrow money more cheaply for public projects.
But not all interest from a state or city is tax-free.
Correct. Like interest paid on a condemnation award if the government takes your property, or interest on a state tax refund. That's typically taxable. The exemption is really for the bond interest itself.
And using U.S. savings bonds for education, is there a break there?
There can be. Interest on Series E savings bonds might be excludable if you cash them in and use the proceeds for qualified higher education expenses like tuition. But there are rules. The bond had to be issued to someone at least 24 years old. The expenses have to be for you, your spouse, or dependent, and there are income phase-outs, so it doesn't apply to everyone.
Let's talk about the big education savings plans, 529s and Coverdell's. What are the tax benefits?
Both are powerful tools. With 529 plans, contributions aren't federally deductible, but the money grows tax-deferred, and withdrawals are completely tax-free at the federal level if used for qualified education expenses.
And qualified expenses are pretty broad now.
Yes. Tuition, fees, books, supplies, required equipment, computers, room, and board. Even K-12 tuition up to certain limits. And you can use up to $10,000 lifetime to pay student loan principal or interest. Coverdell Education Savings Accounts, or ESAs, work similarly tax-free growth and withdrawals for qualified expenses, which could be K-12 or higher ed. But the contribution limit is much lower, just $2,000 per year per beneficiary, and there are age limits for contributions.
And what about ABLE accounts, Section 529A?
ABLE accounts are specifically for individuals who became blind or disabled before age 26. Contributions aren't deductible federally, but again, you get tax-free growth and tax-free withdrawals for qualified disability expenses. These are defined broadly: housing, transportation, health, wellness, etc. Contribution limits are tied to the annual gift tax exclusion. There's a temporary rule allowing some rollovers from 529 plans into ABL accounts.
Okay, almost done with the list. Income from discharge of indebtedness. Usually taxable if debt is forgiving, but lots of exceptions.
That's the general rule, yes. If someone cancels a debt you owe, it can feel like income. But there are many crucial exceptions where it's not taxable income.
Such as?
If the debt discharge happens in bankruptcy, or if you're insolvent, meaning your debts exceed your assets right before the discharge, though the exclusion is limited to the amount of insolvency, if it's a gift from the creditor. There are also specific exclusions for qualified farm debt, qualified real property business debt, sometimes when a seller cancels a buyer's debt or a shareholder cancels corporate debt. And importantly, there are temporary exclusions for certain forgiven student loans through 2025 and for discharge of principal residence debt also through 2025 under certain conditions. So lots of specific situations where forgiven debt is tax-free.
Definitely need to check the details there. Lastly, the tax benefit rule. How does that relate to exclusions?
The tax benefit rule isn't exactly an exclusion itself, but it affects whether a recovery of a previously deducted item is income. Basically, if you took a deduction for an expense in 1 year, getting a tax benefit, and then in a later year you get that money back, like a refund or reimbursement, you generally have to include the recovery amount in your income in that later year. But crucially, you only include it up to the amount of the tax benefit you actually received from the original deduction. If the deduction didn't actually lower your tax in the first year, the recovery isn't taxed. It prevents a double benefit.
Okay, that makes sense. Now, the material applies all this to a student named Paul. Let's run through his situation quickly as a review.
Good idea. So Paul's $1,500 internship bonus, that's taxable compensation, not a gift.
His 400-month grad assistantship, pay for teaching.
Also taxable compensation for his services.
But the $6,000 tuition reduction he got.
That's excludable. It's a qualified tuition waiver for a graduate assistant.
Okay, now the accident settlement. He got money from medical bills, injury, pain and suffering, lost income.
Right. The amounts for medical, $30. The physical injury itself, $100.
Yeah.
Pain and suffering from the physical injury, $50. And lost income due to the physical injury, $15. Those are all excludable because they relate directly to the physical harm.
But he also got $160,000 in punitive damages.
That part is taxable. Punitive damages aren't compensatory for physical injuries, so no exclusion.
And his mother got $25,000 for emotional distress.
That's taxable to her because her distress wasn't tied to a physical injury she suffered.
And Paul can't just relabel the punitive damages now to make them tax-free.
No, not after the fact. This really shows how important it is during settlement negotiations to clearly allocate amounts, especially between taxable punitive damages and excludable compensatory damages for physical injuries. Proper planning could have potentially saved taxes if more was clearly designated as compensatory.
So wrapping this up, it's clear the landscape of income exclusions is pretty vast. It covers everything from education support like scholarships and 529 plans to things like accident compensation, employer benefits, even some investment income like muni bonds.
Exactly. And understanding these rules is really key for you to figure out your taxes accurately and maybe even maximize what you keep after tax. These exclusions aren't random. They exist for policy reasons, relief, encouragement of certain behaviors, fairness.
We've definitely covered a lot today, but it feels like we've only scratched the surface on some of these areas. Each one can probably be its own deep dive.
For sure. The details matter immensely. But hopefully, this gives everyone a solid grounding, a framework for thinking about what might be excludable from your gross income.
Absolutely. A great foundation. Thanks for walking us through all that. We'll talk to you next time.